Welcome back in, ladies and gentlemen. So I want to talk through why I have my investment strategy that I have. Now, I recently been tracking some of the stocks I've been buying, and this is an older video here. As you can see, this is about 3 years old. And I was fortunate enough to find very deep value stocks here. And in this video specifically, I was comparing Kroger and Sprouts Farmers Market. At that point in time, Sprouts Farmers Market was trading at a $2.6 billion market cap. And it was essentially trading, I believe, around 8 or 9 times earnings. And I thought that there was a huge possibility that Sprouts could actually outperform over the next few years. It was trading at a 9.8 PE ratio versus a Kroger 31 PE ratio. And when we take it to a forward PE, it was trading at 11.5 times. And so I came to the conclusion that Sprouts at that point in time was actually a very, very interesting buy. Take a look at today, and it's trading at a $16.8 billion market cap, which means that you would have 8x your money. You would think that this is an anomaly, but I've actually been able to do this multiple times. Now, don't get me wrong, there have been some that I've been completely wrong on. Now, a big reason why I don't have huge numbers in the market is because of medical reasons, but for personal reasons, I've essentially had to liquidate a lot of accounts. And so I am definitely starting over in a lot of ways when it comes to this. Another stock we broke down on the channel was Hims, and I came up to intrinsic value around $2 to $3 a share. It actually hit those levels and now is trading over $42 a share. And even though Palantir is possibly one of the most popular stocks in all of the stock market, it actually wasn't my best performer. And so what I started to realize is when the market is pushing up prices extremely high on one end, you can tend to find some tremendous value looking somewhere completely different and being contrarian. When everybody's pushing up Walmart and Kroger, I was looking at a Sprouts Farmers Market, and believe it or not, when AMD was trading around $8 to $9, I bought AMD and sold it at $13 thinking I got a deal. Well, the joke's on me because AMD ripped up to $107. So when COVID took place and everybody was looking at Pfizer and J&J as the leaders, we'll take a look at what was happening with Lilly underneath the hood. Lilly over the last 5 years had a 500% performance and is now trading only at 37 times earnings after that crazy growth rate. And so as an individual stock picker, this is automatically where my mind goes. If I really want to just expose myself to growing technology, I would buy the triple Qs along with a broadly diversified global index like VT, but that's not my objective when I'm investing. My objective is to absolutely kill the market. And the only way to do that is to look where nobody else is looking or to buy things that nobody else is buying. As long as the fundamentals are still somewhat there and management is executing, it tends to work out most times. Now, of course, there are those cases where management could lie. Some accounting measures could be not as transparent, and those are ones that you definitely want to run away from immediately. So when I take a look at the portfolio I just started this year, my leading positions are Pfizer and Vici. Pharmaceuticals have been a massive underperformer outside Novo and Lilly, and real estate is kind of a contrarian thought when interest rates are on the rise. I don't think I'm going to get monstrous gains with these two names, but these are safe names that should consistently pay a dividend, should consistently raise those dividends. And I do think Pfizer is overlooked, under-owned, and does have some upside opportunity here. Now, when you look at the experts, they have high as 45 and as low as 25 for Pfizer price targets. And there's multiple reasons why they're so divided on the street. There's a patent cliff coming for Pfizer. RFK seems to be dangerous for Pfizer's earnings. And there's a lot of pessimism baked into the stock. But the bottom line is, Pfizer delivered last earnings. They are guiding between $2.80 to $3 worth of earnings, which means that it's trading well below 10 times earnings, paying over a 6.5% dividend. Now, when we compare Pfizer to Eli Lilly, it's very similar to the Sprouts and Kroger. Yes, Kroger is dominating. Yes, Kroger is a bigger company. Yes, Kroger is a better company, but the outsized return could definitely come in the form of Pfizer going forward. Now, there's always boom bust cycles with these biotech companies. We can see the boom cycle, we could see the bust cycle, we can see a boom cycle, we can see an extended boom cycle, and then we see a bust cycle, and then we see a boom cycle, and then now here we are right now in a bust cycle. And normally I would actually be a little bit nervous about this, but the bottom line is Pfizer's fundamentals are actually still good. They're starting to stabilize earnings, which is going to stabilize free cash flow. Their dividend should be safe at this point in time. And the interesting thing is this, Pfizer CEO was on Mad Money and stated in that interview that they're very undervalued, that there's positive oncology treatments coming, that they plan on being a leader in oncology, that the Seagen acquisition is going to start paying off, and they are deleveraging a balance sheet here of high debt. And their big plan is to deleverage their balance sheet, and spend about $10 billion in research and development. So that tells me that the free cash flow of this company is still very strong. They're probably still going to pay that dividend, and they're going to still be doing research and development and mergers and acquisitions while deleveraging. What was concerning to me was the balance sheet. So all these things seem pretty reasonable, and this is why I'm betting on an outsized rate of return for Pfizer here. Now, with Pfizer definitely being a little bit more higher risk, larger cap company, we have Vici here, which I just think is a safe, steady compounder. Definitely not a company I'm going to get rich off of, but what I'm trying to do here is just have some consistency in the portfolio, something safe and reliable. And as I stated before, I'm looking to possibly add into maybe something like a Google or an Amazon here to be the largest part of my portfolio. And I just don't see those opportunities quite yet. Although I will say Google is getting pretty interesting, and that's one that I have been looking at, and I do think it's getting pretty darn close to me pulling the trigger. I want to stay focused on what I'm trying to accomplish here and why it's important for me to find these higher quality contrarian names. So Vici and Pfizer to me are dividend players. They're consistently growing their dividend. I believe Pfizer has hit a bottom when it comes to earnings, and stock price should start following here pretty soon. Now, it might be a year or two, but if oncology starts paying off, we could see this thing double pretty quick. As we saw, some analysts already think it's worth $45 a share. And I think we would see those levels happen almost overnight if some positive news came out on Pfizer. Now, Vici Properties, I'm just expecting small, steady beats, and I'm expecting them to steadily raise their dividend. Intel to me is a little bit of a wild card. It's probably my most concerning position, to be quite honest with you. We're not going to talk about Intel. Now, I did do a video on OpenText. After listening to the conference call today, I'm even more confident that this one can be a compounder. Now, first, nobody is really covering this stock. Schwab, Morningstar, CFRA, Argus, Market Edge has a long position on it. I'm actually tempted to make this one of my largest holdings. Now, revenue has been steadily increasing. They did take a revenue hit recently because they divested a company out of their portfolio. They got hit with FX, and the company has actually been selling off here pretty drastically with trade tension with Canada. Now, this is a Canadian-based company, but does 60% of their business in the United States. This is a pretty ugly chart here, but the fundamentals are actually very strong. They're getting record free cash flow, record cloud bookings, but yet the stock is going down. They're also doing incredible buybacks and paying a nice dividend. Now, after hearing the CEO talk, I'm a lot more confident in OpenText longer term here. Now, originally the stock sold off 5.5%, and I thought this was due to the fact that tariffs being threatened to Canada. Now, on the conference call, he is actually more confident with Trump in office that their business model is going to expand, and he's actually excited about doing business in the United States because guess what? There's no tariffs on their services as of right now. Now, of course, this could change, but as we saw, the stock took a massive hit off of what I think could have been fear of tariffs. They also acquired Eli Lilly and Pfizer as clients in the quarter, and they're projecting very conservative 2 to 4% revenue growth going forward. Now, they did state the first quarter of this year is going to be tough, basically January through March. They bonus out their employees, they give raises, and they believe that margins are going to get impacted from 36.5% down to 29%, but then margins will normalize once again after the first quarter. So they are pretty transparent here. As you guys can see, they're trading at 7.5 times earnings. This is a company that I think can grow probably close to 4%. Now, of course, I think they can grow a lot more than this, but I'm going to take the CEO at his word and say 2 to 4% is what they can do. I personally think we need to be looking at the higher end here. They believe that they can start free cash flowing about $1 billion by 2026, and they're going to free cash flow around $650 million this year. They're trading at an extreme discount, and with the amount of stock that they buy back and with the amount of dividends that they pay, in my opinion, this will reward long-term shareholders for an extended period of time. I definitely think this is tremendously overlooked, undervalued, and I'm just going to keep accumulating here as long as they keep executing. We take a look at Pfizer here, trading at a gap basis at 11 times forward earnings, when peers are trading between 27 to 30 multiple on forward earnings. There is a huge opportunity for them to get multiple expansion and get to closer to 15 to possibly 20 times earnings with any sort of positivity on oncology or any sort of remedies coming out of the Seagen acquisition. And as they pay down debt and as they pay those dividends, you're going to see exponential stock appreciation if they can execute. Now, of course, I think the worst is being priced in, and maybe rightfully so. But I also think there's a lot of opportunity here with the fundamentals being as strong as they are still. If those fundamentals deteriorate and they have that patent cliff, then it's a ticking time bomb. But I do think you're getting paid to kind of see this thing through with nearly a 6.5% dividend. Now, if you thought Pfizer was extremely cheap, take a look at OpenText. On a non-GAAP basis, it's trading at 7 to 8 times forward earnings, while industry is trading at between 25 to 30 times earnings. We take it down to a forward basis on GAAP, it is 50% discounted to its peers, with possibilities of margin growth and top line revenue growth and major partnerships around the corner. Even taking it down to price to book, it's trading at a 50% discount to its peers, and price to free cash flow, as I stated before, is exactly what I like here. They are returning 50% of free cash flows directly to shareholders with dividends and buybacks. So this one also is paying for you to wait. Now, normally when I find these stocks that I think have a good upside or can be market outperformers, they are not returning capital as aggressively as something like OpenText is or a Pfizer is. And they believe they're going to get 25% revenue growth off their cloud business by switching people over to their new platform. This is not including acquiring new clients. This is not including a lot of AI that they're implementing in their business. When you listen to their conference call, it will give you the confidence that this company has the ability to grow well past 2%. So these are a few names I personally have been adding. Now, of course, this is not financial advice, guys. This is just me showing you my process, how I'm finding these names, how I'm looking at their value. Now, I've already given my price target for OpenText and Pfizer, but you guys see me plug in the numbers here of what I think they can actually accomplish as a company by listening to the conference calls, by following experts. The best thing to sometimes do is really simplify things and find the best experts that are covering these names, figure out what their historical multiple is, and then start putting that multiple on where the experts think earnings could lay out to. And that's sometimes the quickest and fastest way to do. And then you add in their growth rate to get a PEG ratio. Not following what the websites are telling you, but you physically doing this is the best way to get your quickest valuations for me personally. I think that's the best way to go. If you're looking at trailing 12 months, you've already missed what the company has done. Now the question is, what do you think they can do? And are they underpriced for what they can do? And I think this is a company that the beginning of this year is going to be difficult for them. Management already laid that out with us. That actually could be why we're seeing that 5 to 6% sell-off. They were talking about 36 to 37% margins, and those margins are going to get hit between 7 to 8% because of raises for employees, growing their workforce, and a lot of the benefits that come with their hiring is why they're going to get hit in the first quarter. Well, the stock sold off about 5 to 6%, which is almost the equivalent to the margins that they're going to lose in the first quarter. So maybe the market's also discounting that as well. I don't know, but after listening to the conference call, I'm confident that there's not going to be a huge problem with tariffs and that growth should start accelerating at the second half of this year. So that makes me very excited to own the name. Then we factor in at between $25 and $30, I think is where fair market is for this company. With dividends reinvested, I think you get an outsized rate of return. Now we throw in the fact, as I showed you guys before, they're trading at a 50% discount to its peers. But let's say they even just close the gap by 20% and they go from 10 times to a 12 times multiple. Well, we're looking closer to an $82 stock by 2032, and that's not including those dividends being reinvested. So I see this one being a pretty strong compounder, and if the company keeps executing, I'm actually tempted to lower my position in something like Intel and putting it into something like OpenText for two reasons. One, I get paid dividends today. And two, I do think that this could be a 2 to 3x stock over the next 7 years. Really hard to say what's going to happen with Intel right now. The reason why I'm owning Intel is I do think that they are going to really capitalize on a PC market demand that's going to turn around over the next few years. I think they're going to announce a new CEO or a possible merger. And I would hate to be chasing the stock when you can start getting it well below book value. So not really a great reason to own the stock. But I do think that a lot of bad news is baked in and not a lot of good news is baked in. What if a PC market demand starts picking up? What if they start taking market share back? What if they get a bomb CEO that can really turn this ship around and get investors excited? And then lastly, what if they decide to split off the divisions or merge with another company? And so that's a main reason why I'm owning it. Not the best reason to own stocks, guys, but as I stated, I am looking for outsized rates of return. If I wasn't, I would just be buying triple Qs to get tech exposure and then layering that with a broadly diversified global index. As always, this is just my opinion, my thoughts. Always appreciate you, and we will see you guys in the next one.